Barbara retired at 69, 26 years as a pharmaceutical sales representative in the Philadelphia area. Her husband had passed away in 2023, and she had inherited his traditional IRA through a spousal rollover, bringing her total retirement savings to $740,000. In 2024, she did what thousands of widows from the Northeast do every year. She sold the house in the Philadelphia suburbs and moved to Sarasota, Florida. Her advisor had told her Florida would save her roughly $8,000 a year in state income tax because Florida has no state income tax on retirement earnings. The move made sense. The climate was better. Her tax bill would be smaller. And then the Medicare premium notice arrived in October of 2025. And her total Medicare cost for 2026 was over $4,200 a year higher than her neighbors, who had stayed behind in Pennsylvania with nearly identical retirement income. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. Barbara is not unusual. Barbara is what happens when a retiree moves to Florida, believes the planning is finished, and stops watching the one number the Social Security Administration actually uses to decide her Medicare premium. My name is Kevin Retires. Every week I break down the tax rules, the Medicare rules, and the financial traps that cost retirees thousands of dollars nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today, I'm going to walk you through exactly what happened to Barbara and how you avoid it. 5 things we cover. First, why Florida retirees are particularly exposed to a Medicare surcharge called IRMAA, even though Florida itself has nothing to do with how IRMAA is calculated. Second, what modified adjusted gross income actually is and why it matters more than your tax bracket, more than your state, and more than almost any other number on your tax return after age 65. Third, the 2-year look-back rule that catches retirees by surprise after a home sale, a Roth conversion, or an unexpected capital gain. Fourth, the exact IRMAA thresholds and tier surcharges for 2026, so you can look at your own tax return and find out today which tier you are paying for. And fifth, the 3 planning moves a retiree in any no-state tax state can make right now to bring future income back below the cliff. This is not about leaving Florida. Florida is still a strong retirement state for many people. This is about what happens to your Medicare premium when you stop managing the one federal number that still determines the bill. Let me set the table before the math. Most retirees never hear the word IRMAA from their advisor until the first premium notice arrives, and by then it is 2 years too late to change the income that triggered it. The retirees who avoid this surcharge are not smarter or wealthier than the ones who pay it. They are the ones who looked at the look-back window before their advisor did. There are 3 specific scenarios I want to walk you through with exact numbers that will not fit in this video. I put them together in a written document I call the Retirement Tax Research. 1, the single widow compression plan for a 71-year-old with $310,000 in combined IRA and pension income, showing how to drop from IRMAA Tier 3 to Tier 1 over 3 years and save $3,800 annually in Part B and Part D premiums. 2, the married couple Roth conversion ladder for IRMAA avoidance, a 4-year plan starting at age 62 that keeps modified adjusted gross income below $218,000 after Medicare begins, preventing at $2,300 in annual surcharges through age 85. 3, the Florida versus Pennsylvania 20-year retirement math, showing the 3 hidden costs that offset no state income tax for a couple with $240,000 in retirement income, with the full dollar comparison, including property tax, home insurance, and IRMAA, plus the current IRMAA tiers for 2026, the Form SSA 44 appeal process, and the complete action checklist for each tier. The link is in the description. First link, it is the Retirement Tax Research. Now back to why Florida exposes retirees to this. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a surcharge. The Centers for Medicare and Medicaid Services adds to your Part B and Part D premiums when your modified adjusted gross income crosses certain thresholds. It was created in 2007, and it now affects roughly 7% of all Medicare beneficiaries, which is about 5 million people. That number is growing every year because the first 4 thresholds are indexed for inflation only modestly, while pension distributions, Social Security benefits, and required minimum distributions all tend to grow faster. The surcharge is cliff-based. $1 over the threshold triggers the full bracket. And the income the Social Security Administration uses to calculate it is not from this year, it is from 2 years ago. Your 2026 Medicare premium is based on your 2024 tax return. Your 2027 premium will be based on your 2025 tax return. This 2-year look-back is the single most important rule retirees do not understand because it means the decision you make this year does not show up on your Medicare bill until the year after next. If you have made it this far, you are already thinking about retirement income in a way most advisors do not bring up. Before I continue, 2 things. Hit the like button. It helps this video reach more retirees who need to hear about IRMAA before their Medicare premium notice arrives. And the complete breakdown with all 2026 thresholds and the Form SSA 44 appeal process is in the first link in the description. Now let me show you the exact math. In 2026, the standard Medicare Part B premium is $202.90 per month. That is what most retirees pay. But if your modified adjusted gross income on your 2024 tax return was above $109,000 as a single filer, or above $218,000 as a married couple filing jointly, your Part B premium climbs into one of 5 IRMAA tiers. Tier 1 raises your Part B premium to $284.10 per month. That is a surcharge of $974 per person per year, just on Part B. Add the Part D surcharge of $14.50 per month, which is another $174 per year. Tier 1 total per person is $1,148 a year. Tier 2 is where the math starts to hurt. Part B climbs to $405.80 per month, a surcharge of $2,435 per person per year. Part D adds another $447. Total per person at Tier 2 is $2,882 a year. Tier 3 climbs to $527.54 per month. That is a Part B surcharge of $3,896 per person per year. Add the Part D surcharge of $719. Total per person at Tier 3 is $4,615 a year. Now look at Barbara. Her 2024 modified adjusted gross income included pension income, Social Security, a small amount of dividends, and the capital gain from her Philadelphia home sale after the $250,000 single filer exclusion. That gain pushed her 2024 income to $184,000, landing her in single filer Tier 3 for 2026. Her total Medicare surcharge for the year is roughly $4,200 above what a retiree with no IRMAA exposure pays. And because the Social Security Administration uses a 2-year lookback, her 2025 income, even if it dropped back to $70,000, does not help her until 2027. The Florida part of this story is not about the state itself. It is about the planning culture that surrounds retirees there. Here's what happens. When a retiree lives in Pennsylvania, the state exempts nearly all retirement income from state income tax for residents age 59 and a half or older, pensions, Social Security, traditional IRA distributions, 401k withdrawals. Pennsylvania takes 0 at the state level. A retiree and their certified public accountant in Pennsylvania have one lever left to pull at the federal level. That lever is modified adjusted gross income management. Because there is nothing to optimize at the state level, the accountant focuses on Roth conversion timing, qualified charitable distributions, tax loss harvesting, and IRMAA bracket avoidance. When the same retiree moves to Florida, the conversation changes. Florida has no state income tax on anything. The advisor celebrates this. The retiree thinks the planning is complete. Nobody is running quarterly income projections. Nobody is modeling Roth conversion ladders to compress future required minimum distributions. Nobody is timing capital gains across tax years to stay below an IRMAA cliff. The advisor treats the Florida move itself as the tax strategy, and the retiree stops monitoring the one federal number that still matters. And here is what makes it worse. Retirees who move to Florida typically sell a primary residence in a market where prices have appreciated over 20 or 30 years. Even after the primary residence capital gain exclusion, the remaining taxable gain can be substantial. Barbara's home sale triggered $220,000 of reportable long-term capital gain in a single year. There are 3 federal levers the Florida retiree still has. First, the Roth conversion ladder during the gap years between retirement and age 73 when required minimum distributions begin. Moving traditional IRA money into a Roth during those years shifts the tax hit forward in time, and, more importantly, permanently reduces the IRA balance that drives future required distributions, which drives future income. Second, qualified charitable distributions. A retiree age 70 and a half or older can direct up to $115,000 per year from a traditional IRA straight to a qualified charity. That money never touches the income calculation Medicare uses. For a charitably inclined retiree, this is the single most powerful IRMAA reduction tool available. Third, the life-changing event appeal using Form SSA 44. If income drops significantly in the current year due to retirement, death of a spouse, divorce, loss of pension income, or other qualifying events, the Social Security Administration can use the current year instead of the 2-year look-back. This form is severely underused by retirees, especially widows and widowers. Run this through 2 real situations: same income, same age, same retirement savings, different planning culture. Barbara is 71, widow, single filer, now living in Sarasota, Florida. Her 2024 income was $184,000 because of the home sale. Her 2026 Medicare surcharge is $4,200. Her advisor did not file Form SSA 44 because nobody told her she could. Her advisor did not run Roth conversions in 2021 through 2023 because she was still working, and her income was already over $150,000. Her advisor did not consider qualified charitable distributions because nobody brought it up. The Florida move was treated as the tax strategy, and now she's paying $4,200 a year more than she needs to for Medicare. Carol is also 71, also a widow, also a single filer with the same retirement savings, still living in suburban Philadelphia. Her 2024 income was $72,000. Her Medicare premium for 2026 is the standard $202.90 per month. Zero surcharge. What did Carol do differently? She worked with a certified public accountant who had only one lever to pull, federal income management, because Pennsylvania was already exempting her pension and IRA distributions from state tax. In 2022 and 2023, when her income was lower after her husband's retirement but before he passed, they converted $60,000 per year from traditional IRA to Roth. That reduced her 2024 IRA balance, and therefore her 2024 required distribution pressure. When her husband passed in 2023, Carol filed Form SSA 44 with the Social Security Administration, documenting the loss of his pension income, and had her 2024 IRMAA determination recalculated based on her new widow status income, not the joint filing income from her husband's final working year. She did not sell a highly appreciated home to relocate. She did not trigger a $220,000 capital gain. She kept her income below $109,000 for single filers in 2024. The difference between Barbara and Carol is not Florida versus Pennsylvania. The difference is one woman treated the state move as the plan, and the other woman treated the plan as the plan. But I would not be doing my job if I did not give you the full picture. Florida still has real financial advantages for retirees. Zero state income tax means the state never taxes Social Security, never taxes pension income, never taxes traditional IRA distributions, never taxes Roth conversions, never taxes capital gains. For a high-income retiree with $250,000 of retirement income, that is genuinely $7,000 to $9,000 a year in state tax savings compared to California or Minnesota. That is real money. And Florida also has a homestead exemption, a Save Our Homes cap that limits property tax increases to 3% per year for existing homeowners, and no state-level estate or inheritance tax. Florida is not a mistake. It is a strong retirement state. The mistake is believing the move alone is the plan. Here is your action checklist. 6 steps starting this week. Step 1, pull out your most recent federal tax return, Form 1040 or 1040 SR, and find your modified adjusted gross income. Step 2, go to Medicare.gov and look up the current IRMAA thresholds for your filing status. Determine which tier your 2024 income placed you in. Step 3, if you experienced a life-changing event in 2025, such as retirement, death of a spouse, divorce, or loss of pension income, download Form SSA 44 from socialsecurity.gov and file it with your local Social Security office. Approval rates for legitimate life-changing events are high, and this can eliminate IRMAA entirely for the current year. Step 4, project your 2025 income using your 2025 documents. This is what will determine your 2027 Medicare premium. If it is over the threshold, you still have until December of this year to use strategies like qualified charitable distributions to reduce it. Step 5, if you are age 70 and a half or older and you are charitably inclined, ask your IRA custodian how to set up a qualified charitable distribution for 2026. The annual limit is $115,000 per person, and it reduces your income calculation dollar for dollar. Step 6, talk to a tax professional who has updated their approach for IRMAA bracket management. Most advisors trained primarily for state tax optimization have not recalibrated for the federal levers that still matter in Florida, Texas, Tennessee, and Nevada. Drop a comment. Tell me what state you retired to and whether your advisor has ever run an IRMAA projection for you. I read every single one, and the most common situations become future videos. Before I close, here's the reflection I want you to leave with. Barbara is not a cautionary tale about Florida. She's a cautionary tale about what happens when any retiree assumes that one good decision finishes the work. The move to a no-state tax state is a good decision. It saves real money every year, but it is one move. The management of modified adjusted gross income is not a one-time decision. It is an ongoing discipline year after year, from the year you retire until the year you no longer file a tax return. The retirees who win this game are not the ones with the biggest retirement accounts. They're the ones who keep one eye on the federal lookback window while everyone else is celebrating the state tax savings. This is Kevin Retires. If this video helped you, hit the like button right now. It takes 1 second and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. And if you know someone who moved to Florida or is thinking about moving to Florida, send them this video today. The difference between knowing about IRMAA and not knowing about it could be $30,000 or more over a 20-year retirement. I will see you in the next one.